Hello, everybody. Vanakkam, Chennai. How are you all doing? Myself, Professor Pritesh Veera here. I'll be here to help you with your CA Foundation Economics subject. How are you all doing? Hi, Priya. Hello, Hemlata. Hello, Yamuna Devi. Very good evening, Priya V. Priyadarshini. Hi, everyone. So today we are going to start with the chapter by the name of Theory of Demand and Supply. Good evening, Amu. Good evening, Rajeshwari. Very good evening, everybody. Hope you all are doing well. Hello, Harshad. Hello, Vanakkam. So I don't know to speak Tamil, but I can definitely teach you all in English. All right. So I think we should not be wasting any more time. And we should be starting with our very first topic that we are supposed to cover. One of the most important topics in your syllabus, a weightage of anywhere between 15 to 20 marks, can be 15 for sure. So, beta, first of all, we need to start with the concept of demand. Now, what do you mean by the word demand? Yes, I want to know from you all, in your opinion, what is the concept of demand? So we all know that demand is equal to desire for a commodity backed by the ability and the willingness to pay. So basically there are three components. Demand should have desire, demand should have ability, and demand should have willingness. If all these three components are present, then we term the concept to be as demand. A yes or no? Are you all there with me? Hello Prem, hello Preeti. I'm doing well. Thank you so much. Hope you are doing well as well. So quickly, I want to reply in the chat box. Do you agree that demand is equal to desire plus ability plus willingness? So Abdul, is demand only the desire? Desire needs to be backed up by ability, and ability along with the willingness to pay for money. Because many times you have people who have desire, who have the ability, but they are not willing to spend. So whenever you talk about demand, only ability and desire do not frame up to be demand. Yes, Abdul. Then we say that demand is a relative term. Related to what? It is related to two concepts. One is by the name of price, the other is by the name of time. And we all should know the relationship between price and quantity demanded, because can I say that demand is a function of price. Demand is dependent on price of a commodity. So what do we say? Other things remaining constant. Ceteris paribus. Higher the price, lower the demand. Lower the price, higher the demand. This is called as law of demand. This is called as law of demand. So demand is dependent on two factors. One is price, one is time. When we consider about price and time, we call it as a relative term. Demand curve is a downward sloping curve from left to right. So this is your left, this is your right, and demand curve slopes downward from left to right, indicating an inverse relationship between price and quantity demanded. Yes, dear students, absolutely correct, Preeti. Lovely. Chalo, next, what are the types of demand? So the very first category that we have is by the name of individual demand. When a particular person demands a particular commodity, it is individual demand. So my demand for mangoes is particular consumer demanding a particular commodity, individual demand. But am I the only one demanding mangoes? No. 100 people demanding mango is also termed as market demand. So when the consumer is one, individual demand. When the consumers are more than one, but the commodity is the same, then we term it as market demand. Yes, dear students. Then we have something called as direct demand. Direct demand is for consumer goods. We directly demand certain goods which can satisfy our wants directly. For example, I demand a mobile phone. That mobile phone that I am demanding is an example of direct demand because it is a consumer good. Now there are certain producer goods. For example, factors of production. Whenever we talk about factors of production, bolo, land, labor, capital, entrepreneur. Can I say they are the factors of production and all of them have derived demand for a consumer. A consumer does not demand land, labor, capital or entrepreneur directly. The consumer demands land, labor, capital, entrepreneur indirectly. So I will demand a mobile phone directly. But for manufacturing this mobile phone, I will demand factors of production indirectly. Hey, yes or no? I'll let you know, Abu. So, what are the four categories? First one is individual demand, second one is market demand, third one is direct demand, fourth one is indirect or derived demand. Then comes one of the most important concepts by the name of competitive demand. Competitive demand is for substitute goods. Now, whenever I say substitute, I mean to say there are two commodities. So when the price of Pepsi rises, the demand for Coca-Cola will also rise because people will substitute a high priced commodity with a low priced commodity. So when Pepsi becomes expensive, people will substitute Pepsi with Coca-Cola. Therefore, the arrows are going in which direction? Are the arrows going in opposite direction or the arrows are going in the same direction? Tell me. Yes, Akshaya, you will be. I will be letting you know when and where. Yes, Harshad. So it is direct relationship. I repeat, this is direct relationship because the arrows are going in the same direction. So higher the price of Pepsi, higher is the demand for Coca-Cola. Lower the price of Pepsi, lower. So if there is competitive demand, we have another category by the name of joint demand. Joint demand means tied demand. Now tied demand is for complementary goods. Complementary goods, again we are talking about two commodities. And in those two commodities, again we will have an inverse relationship. So for example, when the price of fuel, X commodity rises, the demand for Y commodity vehicle will fall down. Now the arrows are going in opposite direction. So if the arrows go in the same direction, direct relationship. If arrows go in opposite direction, then it is inverse relationship. Here I am talking about two commodities, price of one commodity affecting the demand for another commodity. So beta, competitive demand is for dash goods. Chalo everybody quickly in the chat box. Competitive demand is for dash goods. Options are substitute goods or complementary goods. ये बोलो. Very good, Abu. So substitute goods have competitive demand and the relationship between them is direct. Complementary goods have joint demand and these goods have inverse relationship. So arrows go in the opposite direction. Then we have something called as composite demand. One commodity having several uses like electricity, like mobile phone. Commodity is one, but whenever we talk about the uses, there are multiple. So one commodity having multiple uses, we call it as composite demand. Then, what are the determinants or factors affecting demand? So the very first factor is price. Higher the price, lower the demand. Lower the price, higher the demand. There is an inverse relationship. Then we have something called as money income. Now we can have direct relationship for normal goods. No change in demand for necessity goods like meds and salts. And inverse relationship for inferior goods. So if income rises and demand for a commodity rises, or if income falls and demand for a commodity falls, the relationship is direct, which means these goods are normal goods. They have positive income elasticity of demand. Now in other case, when your income rises, your demand remains constant. Now when does demand remain constant? In case of medicine, in case of salt, in case of certain essential commodities. And if your income rises, your demand falls. So if I ask you, if your income rises, what will you wear, Preeti? Will you wear Adidas or Bhaidas? Adidas is a premium quality, Bhaidas is a inferior quality. So if your income increases, your demand for Adidas will also increase. Yes, I will, Amu. So whenever the arrows go in the same direction, we call it as positive income elasticity. When there is no change in demand due to income, zero income elasticity. And when arrows go in the opposite direction, we will call it as negative income elasticity of demand. Then we are already done with the third point. Price of related goods. Two type of goods. One is substitute goods. A yes or no. And the other one is complementary goods. So complementary goods, the demand is dependent on the price. There is an inverse relationship. Yes, Pragatish, I will be sending. You need to download the app for Thankyou. In that app, they will be sharing the notes with you all. All right. Then future expectation about price. If you expect the prices to rise in the future, then your present demand will be more. In the current, if the price rises, then what happens? If you're expecting the prices to rise even further, then the relationship is direct. Then we have a point by the name of taste, habit, fashion, advertisement. So beta, if a taste, if the taste of the commodity is favorable, then you will demand more. If the taste is not so favorable, then the demand will be less. So people in Chennai eat rice. So your taste towards rice is favorable. I don't like rice as much. So my demand for rice will be less. Habitual goods. Liquor, cigarettes, bida. All these people are habituated. Fashion, if it is latest, then the demand will be more. If it is outdated, then the demand will be less. If the advertisement impact is Rambanalla, then the demand will be more. If the advertisement effect is not so good, then the demand will be less. We call this as a bandwagon or a demonstration effect. That is, we try to imitate the consumption patterns of other. So when you try to imitate the consumption pattern of other person, we call it as a bandwagon or a demonstration effect. Then we have population. Beta, in India, we are only 120 crores and counting. Today we are more than 140 crores and counting. By tomorrow we will be 142 crores. So as population rises, the demand will also rise. Population falls, the demand will also fall. Then if you are in the age group of 0 to 14, then you will demand toys and chocolates. If you are in the age group of 14 to 59, then you will demand electronics and vehicle. If you are in the age group of 60 and above, then you will demand medicine, wheelchair. So beta, if you are a small child, you will demand Mammy Moko pants, Achhi Nini Lai, diapers. Yes or no? So one point is population, another point is age, another point is sex ratio. If there are more males in the economy, male products will be demanded. If more females, then female products will be demanded. If the distribution of income is equal, then the demand will be more. If the distribution of income is unequal, then the demand will be less. Chalo bachcha log, are we all clear? Are you all understanding? Is there any point on which you want me to focus in detail? You can let me know. I am giving an overview of the entire chapter. But if you want me to explain a particular point, you can post it in the chat box. I will definitely help you with your doubt. So if you have any doubts, किसका है ये तुमको इंतजार में हूं ना, which means if you have any doubts, what are you waiting for? Christmas, come to me, I will solve your doubts. Chalo everyone, shall I go to the next part? Yes dear students, shall I? Beta Preeti, Snob and Veblen effect are examples of exception to the law of demand, which I will be covering right now, which is opposite of demonstration effect. You don't imitate. So I will be explaining you that, Preeti. Till now is everything clear? If yes, give me a Rombanalla. Harshad, I'll come to it as I told you. So I don't see any doubts coming till now. So if income distribution is unequal, rich will become richer, poor will become poorer. And only rich will be able to demand, whereas poor will not be able to demand. And therefore income distribution if unequal, then the demand will decrease. If the distribution of income is equal, then everybody has the purchasing power, everybody has the money to spend. Example of unequal distribution, beta. India is a classic example of unequal distribution of income, where the rich becomes richer and the poor becomes poorer. So if in an economy there are 5 people, one person gets 1 lakh, another person gets 50,000, another person gets 5 lakh, one more person gets, say for example, 20,000, and another person earns 10,000. Now is this equal distribution of income or an example of unequal distribution of income? Now in the economy there is a mobile phone. That mobile phone is, say for example, worth 30k. How many people can actually afford that mobile phone? Is only a couple of people who earn 1 lakh and 5 lakh rupees. So demand will be only by 2 people. But if imagine everybody gets more or less equal distribution of income, then they will be equal to demand more. Am I clear? Yamuna, I will come to that point. Now, we have to study the law of demand. Under the law of demand, we say other factors remaining constant, which in Latin language is called as ceteris paribus. We already know the relationship is inverse. The price will vary, whereas other factors will remain constant. We know that there is a functional relationship between price and quantity demanded. We do not do any kind of measurement. Therefore, law of demand is a qualitative statement. Why is law of demand a qualitative statement? Because there is no measurement. Now, how does the demand curve slope? It slopes downward, it is negatively sloped, and it is convex to the origin. Now, this part is a little important. Why does the demand curve slope downward? So we should know the answer, because there is an inverse relationship between price and quantity demanded. So the next question is, why is there an inverse relationship? Because there are four reasons. There is an inverse relationship between price and quantity demanded because of four major reasons. The first effect is called as income effect. Now, income can be classified into two, which is money income and real income. Now, beta, money income is the relationship between income and demand, whereas real income is the relationship between price and quantity demanded. So, whose relationship do we want to find? Do we want to find the relationship between income and demand? We want to find the inverse relationship between whom and whom? Price and quantity demanded. So we are not going to study money income. We have already done that. Positive income elasticity, negative income elasticity, zero income elasticity. Now we are going to talk about real income. So being students of economics, you should be aware that there are two types of income. One is called as real income. The other one is called as money income. Everybody believes that there is only one concept called as money income. Only economic students know that there is another concept by the name of real income. Real income is also called as purchasing power, or it is called as value of money, and it is the relationship between price and quantity demanded. Yes or no? So if I tell you that your money income is rupees 100, price is rupees 5, then you can purchase 20 units with 100 rupees income. Yes or no? We will assume that money income remains constant, and if the price is rupees 10, you can only purchase 10 units. So when the prices are low, the units demanded are more, which means your purchasing power is more. If the price rises, your purchasing power decreases. Therefore, the relationship is inverse because of value of money. So we all know that the relationship between price and quantity demanded is inverse. But the reason wajah tum ho is the value of money or the purchasing power. Yes, dear students, are we clear? Have you all understood? So the very first reason that we are studying is by the name of which effect? Income effect. Next one is by the name of substitution effect. So when the price of Pepsi rises, we know that the demand for Pepsi falls. So Arshad, we are not supposed to study that because we are talking only about normal goods. So law of demand is applicable only on which goods? Only in case of normal goods. So the relationship between price of Pepsi and demand for Pepsi is inverse because of availability of substitute, that is Coca-Cola. So if Pepsi becomes expensive, the demand for Pepsi falls. Reason is that Coke is comparatively cheaper. So people will purchase a cheap price commodity or a low priced commodity. The third reason is number of buyers. Again, we know that the relationship is inverse. This is the reason behind it. When the prices are high, new buyers exit the market, and lesser the buyers, lesser is the quantity demanded. So the relationship is inverse. And finally, the fourth point is by the name of utility. When the price rises, it gives you comparatively lesser utility. Because earlier the commodity was available at a lower price. Now the same commodity is available at a higher price. So comparatively, the utility that we receive is less. And if utility is less, the demand will be less. So again, we know that the relationship is inverse. But reason is utility. Yes, dear students. So total how many reasons? 4. Real income, substitution effect, number of buyers on new buyers effect, and the law of DMU. DMU means diminishing marginal utility. But a marginal utility curve slopes downward. Demand curve also slopes downward. Matching, matching. Yes, Harshad, are you clear with your doubt? Vasant, have you understood? Abu, any questions? Waiting for your reply. Kindly reply in the chat box. Are we clear? Okay. Now we have to study something called as exceptions. Exceptions are those which do not follow the law. So all the exceptions have direct relationship because the law says inverse the relationship. So exceptions are those which do not follow the law. So what are the exceptions? Higher the price, higher the demand, lower the price, lower the demand. The relationship is direct. Exceptions, the curve for all exceptions is an upward sloping curve. Again from left to right. And here comes the concept of Veblen goods or the concept of snob appeal. So luxury goods have a prestige value. They are also called as conspicuous goods or snob appeal or Veblen effect. Now beta, Veblen effect is a high priced commodity. You want to keep your social status high. So Veblen effect is that effect in which your social status matters. So if diamond becomes expensive, people will on purpose purchase more diamonds. So sir, what is the difference between Veblen effect and snob appeal? So snob appeal is you want to be class apart. For example, if everybody is drinking a glass of whiskey, you will drink a glass of wine. For example, in your economy, majority of the people have Mercedes Benz. You will have an Audi. If everybody has an Audi, you will have a Lamborghini. If everybody has a Lamborghini, you would want to have a Bugatti. That means keeping you class apart. So to have a prestige, to keep your social status, we call it as Veblen effect. This concept was given by a person by the name of Veblen. Hence, the name is Veblen effect. And when you want to be class apart, then it is called as snob appeal. In both the cases, the commodity is a luxury. Hence, one concept, five names: luxury goods, prestige goods, conspicuous goods, also called as snob appeal or Veblen effect. Am I clear? So somebody had asked me a discussion about what is the difference between snob appeal and Veblen effect. I hope I have been able to clear your doubts, queries. Shall I go ahead? Can I have a reply in the chat box, everybody? I hope you all are having a good time. Bole to lovely. All right. The next one is by the name of Giffen goods, given by Sir Robert Giffen, and the example is bread and meat. When the price of bread falls, actually the demand for bread should have increased, but it did not. It rather fell, showing a direct relationship because people preferred a superior commodity. Thank you, Vasant. So, are we all done? Next one is by the name of conspicuous as well as a necessity. So in the past it was a luxury, but in the present it has become a necessity, like a fridge, AC, machine, or a mobile phone. In the past they were considered as luxury goods, but in the present they are now considered as a necessity. Such goods are called as conspicuous necessity goods. Yes, dear students, are we all clear? The next one is future expectation about price. The example can be gold, wheat, or rice. If you expect the prices to rise in the future, then the demand will increase in the future, in the present rather. And if you expect the future prices to fall, your present prices will also fall. Prem, what do you mean by a new topic? Today I am going to cover the entire chapter number 2. The next is speculative goods, which is particularly shares. So the same impact as future expectation about price. Future expectation about price is for goods, whereas speculative effect is for shares. Then demand for necessities like meds and salts does not change. It remains constant. Yamuna, when the price of bread falls, what should happen to demand for bread? So ideally, when the price of bread falls, the demand for bread should rise. But Sir Robert Giffen said that this is not the case in case of bread. He had observed this. And he observed that when the price of bread fell, the demand for bread also fell because people substituted bread with meat. They opted for a superior commodity. So, what is the relationship? Direct. And hence, Yamuna, the answer for given goods is direct relationship. Are we clear? You will be updated on the HiQ site, Prem Kumar. So first we will cover all the microeconomic chapters, chapter 2, chapter 3, chapter 4, chapter 1 and 5. Then we will go to the macroeconomic part. Yamuna, is your doubt cleared? Sure about it? All right. Then we go to the next part, irrational behavior. Here I have written Didi ka night dress. Didi ka night dress means my wife purchased night dress. So basically, she purchased a lot of night dresses, 7 of them. And when I asked her, why have you purchased so many night dresses? Her answer was, because I liked it. So this is called as an irrational behavior. So let me not get into more details because I might be in trouble. She might be watching this YouTube lecture and tomorrow I might not be alive if I get into the details of the things. So irrational means most of the times we just feel like purchasing and we do not consider the price of the commodity. Just because we felt like purchasing, we purchased the commodity. Such a effect is called as impulsive purchase. And the last one is ignorance effect. So beta, the way you have iBaco ice creams in Chennai, there is an ice cream parlor by the name of Baskin Robbins in Mumbai. So Baskin Robbins logo is somewhat like this, wherein you can see 31. Now this 31 means that on every 31st they offer 31% discount. Now many of the people are not aware only. They are ignorant about the fact that Baskin Robbins offers 31% discount on every 31st. So beta, what is the price on every 31st? On every 31st, the prices in Baskin Robbins are less. So ideally, the demand should have been more. But people are unaware, ignorant, and therefore they do not demand more. Rather, they demand the same quantity, which should have been more, but comparatively less. So the relationship is direct. Yes, dear students. Shall we go ahead? Now, demand gets affected due to two factors. The most important factor is price of particular good. And then there are other factors than price, like income, population, price of substitute good, price of complementary good. So whenever it is due to the price of particular good, we call it as change in quantity demanded. And whenever it is due to other factors, we call it as change in demand. So beta, change in quantity demanded is due to price. Change in demand is due to other factors than price. Now, there are two concepts. One is contraction in demand, another is expansion, and the reason behind them is price. Higher the price, lower the demand. Contraction. When price rises, demand falls. We call it as contraction. When price falls, demand rises. We call it as expansion. So if you observe the diagram, price rises from P to P1, quantity falls from Q to Q1. If price falls from P to P2, then quantity rises from Q to Q2. There is an upward movement in price called as contraction. Upward movement in price means price rises. If price rises, quantity contracts. And there is a downward movement in price where price falls. That means demand rises, which is called as expansion in quantity demanded. So beta, demand gets affected due to how many factors? Everybody quickly. Two. One factor is price of particular good, other is other factors. Because of price, the name of the concept is change in quantity demanded, or it is called as variation in quantity demanded. Hey, yes or no? Now, when we go to the next part, it is called as two parts: contraction and expansion. Contraction in demand is due to a rise in price. Expansion in demand is due to a fall in price. Whereas when you talk about change in demand, so change in demand we have two concepts. One is increase, one is decrease. But under increase and decrease in demand, price is not the factor. It is other factors. So price remains constant, yet demand is more. If at the same price, more is demanded. Repeat, if at the same price, more is demanded, then it is called as increase in demand. If at the same price, less is demanded, then it is called as decrease in demand. Now, increase and decrease is to the right or the left. So in short, Yamuna, Preeti, Prem, Vasant, if you need to remember the four concepts, expansion, contraction, increase, decrease, you need to remember this. Now, for example, if this is my price, chalo everybody, what is this? This is price. Price rise is contraction. Price falls, expansion. So Bharatnatyam, step number one, price rises, expansion. Price falls, contraction. If this is quantity which goes to the right, quantity to the right, increase. Quantity to the left, decrease. So Bharatnatyam, four steps. Chalo everybody, yes or no? Step number one, contraction, expansion. Right may increase, left may decrease. This is rise in price, price rises. This is fall in price, price falls. Quantity goes to the right, quantity goes to the left, and this is your concept of expansion, contraction, increase and decrease. Bolo Rambanalla. Whenever it is expansion, contraction, we call it as movement along the demand curve. Whereas whenever it is due to other factors, we call it as shift. On one demand curve, if you get different points, it is called as movement. Yes or no? Yeah, you all there. Hello. Can I have a reply in the chat box? Have you all understood? So with this, I have completed the first part, that is theory of demand. I'll go to the next part, that is elasticity. But first, I want to ask you doubts. If you have any questions, please post it in the chat box. I am waiting for you. All right, that's wonderful. Good to see so many responses. Would love if everybody else can start reacting in the chat box. If you like the lecture, do like, share, subscribe, comment, hit the bell icon. Thank you so much, Priya. Means a lot. Senjavare. I have heard some word. I don't recollect actually. There is some Dhanush, if I'm not wrong. Rombanalla. Rombanalla Erko. Something like this. I don't recollect actually. It was years ago that I had come to Chennai, and students in Chennai had taught me. Thank you so much, Preeti. So everybody, shall we go to the next part? Are you all ready for elasticity of demand? Thank you, Abu. So, beta, now we are going to study elasticity. Elasticity basically means measurement. In the entire demand chapter, we have not done any kind of measurement. What did we do? Higher the price, lower the demand, lower the price, higher the demand, called as law of demand. Then higher the price, higher the demand, lower the price, lower the demand. Exceptions to the law of demand: higher the price, lower the demand, called as contraction; lower the price, higher the demand, called as expansion. Same price, more is demanded, increase. Same price, less is demanded, decrease. So in the entire chapter, what have we studied is directions. We have not spoken about measurements. By how much did the demand change? Did we speak about that? So are we only supposed to study directions? Or we should also measure the change in demand? We should measure the change in demand. We will be doing that, Dhanvant, don't worry. Today we are going to complete theory of demand. Ayyo, first chapter should not be even a doubt, Anna. Oh. So, now we are going to measure the degree or responsiveness, that is, or sensitiveness of change in quantity demanded due to change in price, for which we have studied the formula. Percentage change in quantity demanded upon percentage change in price. This is the formula when you use percentage sign. But if you want proportionate, so delta Q upon Q divided by delta P upon P. But we are Indians, we don't believe in division. Therefore, delta Q upon Q multiplied by P upon delta P. How do we calculate delta Q and delta P? Is new minus old. I am sure everybody knows this. Koncham Priya. Many years ago, Vasant. So, in demand, we had only studied directions, but in elasticity of demand, we are going to study what? We are going to study the measurement, that is the change in demand due to the change in price. So, whenever, if I am doing this action, can I say this is the law of demand? Higher the price, lower the demand. Now, you need to ask me a question: by how much? Pucho. Ask. Higher the price, lower the demand. What will you ask? What will you ask? अरे पूछो. अरे पूछ. So by how much? या तो in more proportion or in lesser proportion. Either you will ask, very good, Abu. So if demand changes in more proportion, then it is elastic. If demand changes in less proportion, then it is inelastic. So when price rises, demand falls, you will ask the question by how much? Either it will fall by a greater proportion or by a lesser proportion. Yes or no? More proportion means elastic. Less proportion means inelastic. So this is your price, this is your quantity demanded. Due to price, the change in quantity is less. Less change means inelastic. And if due to price, quantity demanded responds more change in demand is called as elastic. So we term it as E less than 1 and E greater than 1. If E is greater than 1, then it is elastic. If E is less than 1, then it is inelastic. If E is equal to 1, then we called it as unitary elastic. Hey, yes or no? Are you all there with me? Are you all understanding? So what have I done over here? See beta, this is price, this is quantity demanded. Price rises, quantity demanded falls. Price falls, quantity demanded rises. So this part over here is the law of demand. In the law of demand, there is no measurement. There are only directions. Therefore, it is a qualitative concept. But do we want to study only the law of demand? Ananana. We want to study the concept of elasticity of demand. So when demand falls, you will ask by how much. So either there will be more change or less change. More change is elastic greater than 1, less change is inelastic, it will be less than 1. Shukriya Vasant Raj. Now when price falls, demand rises, you will again ask by how much. So again your answer will be either there is more change or less change. So demand can fall by more proportion, less proportion. Demand can rise in more proportion or less proportion. So again more proportion is elastic, less proportion is inelastic. And in elasticity of demand we consider measurement, therefore it is the quantitative concept. So this is qualitative, no measurement. This is quantitative because there is measurement. Now we have something called as price elasticity. I am sure everybody is clear with that. Price elasticity, we study 5 types. I hope I need not discuss that. Percentage change in the quantity demand upon percentage change in price. Delta Q upon Q divided by delta P upon P, or delta Q upon Q multiplied by P upon delta P. Then we have income elasticity, even that we have 5 types divided into, see there are 3 categories into 5 types. So first of all you can get direct relationship. Income rises, demand rises, income fall, demand falls, such goods are called as normal goods. Now what are the possibilities? 10% upon 10%, answer is 1, unitary, positive number. Change in demand is 5%, but change in income is 10%. So your answer is 0.5, inelastic. This will generally happen in case of necessities, food, clothing, shelter. Then there will be more than proportionate change in case of luxury goods, therefore it is elastic. So when you study the first category, positive means it can be 1 greater than 1 or less than 1. 1 is exactly equal change, less than 1 is less than proportionate change, more than 1 is more than proportionate change. Yes or no? Are we all clear? Have you all understood? Now there is another possibility that there is no change in quantity demanded. No change means 0. And there can be inferior goods in which we'll have negative income elasticity of demand, that is inverse relationship for inferior goods. So if the goods are normal, positive. Under positive we have 3 categories: 1 greater than 1, less than 1. 1 is a coincidence, greater than 1 for luxuries, less than 1 for necessities, equal to 0 for essential commodities. And if the answer is negative, then it is inferior goods. Then we have cross elasticity of demand, under which I have again written there are 4 categories, out of which 2 we are already done. Substitute goods have a direct relationship. Direct means positive cross elasticity of demand. Positive may we call it as very high and the demand is elastic. So substitute goods have elastic demand. Then we have complementary goods. Complementary goods, the relationship was inverse. Price of fuel rises, the demand for vehicle falls. Yes or no? Therefore, inverse means negative, negative means very low means inelastic. So, complementary goods have inelastic demand. What a beautiful concept. Substitute goods, elastic, complementary goods, inelastic. Substitute goods, positive, complementary goods, negative. Substitute goods, direct relationship, complementary goods, inverse relationship. Substitute goods called as positive cross elasticity of demand, that is very high, whereas complementary goods inverse relationship, negative income cross elasticity of demand, therefore very low, inelastic. Then we have perfect substitutes, homogeneous goods. Example is an agricultural good, potato. There can be tremendous, huge, infinite, immeasurable change. So we call it as infinite cross elasticity of demand. And then there can be unrelated goods. For example, the price of bottle affects the demand for banana. Beta, price of bottle, can it affect the demand for banana? Is bottle and banana related goods or they are unrelated goods? They are unrelated goods. And unrelated goods have zero income elasticity of demand. Now, the next one is advertisement elasticity of demand. Advertisement elasticity of demand means that there is a change in quantity demanded due to change in advertisement expenditure. Yes, absolutely correct, Priya. Absolutely correct, Amu. Now, we all have studied that there are 5 types of price elasticity of demand. Yes or no? So if I have to talk about 5 types of price elasticity of demand, beta, percentage change in quantity demanded is equal to percentage change in price. We call it as unitary elastic demand. So when a change in the price of the commodity brings about exactly equal change in the quantity demanded, then it is called as unitary elastic demand. Then percentage change in quantity demanded is greater than percentage change in price. That means demand is more than 1, greater than 1. We call it as relatively elastic demand. E is greater than 1. We will get a flatter curve. Percentage change in quantity demanded is less than percentage change in price. Then we call it as relatively inelastic demand, where E is less than 1. If the percentage change in quantity demanded is 0, no change, then we call it as perfectly elastic demand, where E is equal to, perfectly inelastic, because there is no change. So if there is no change, it means inelastic. So perfectly inelastic demand, where E is equal to 0. And if percentage change in quantity demanded is infinite, We then call it as perfectly elastic demand, where we can say that E is equal to infinite. So basically there are how many categories? Five categories. Now whenever I have to draw a curve, then how do we draw the five curves? Vertical line parallel to x-axis. What is vertical line parallel to x-axis? Then we call it as E is equal to 0, no change in quantity demanded. Horizontal line parallel to y-axis. E is equal to infinite. If the curve is a flatter curve greater than 1, if the curve is a steeper one, we call it as less than 1. And if you get a equidistant curve from the axis, a linear curve, a rectangular hyperbola curve, we call it as E equal to 1, which is your Panch ka dam. Panch ka dam means what? This is a horizontal line parallel to x-axis. This is called as E equal to infinite. This is the vertical line parallel to y-axis. E is equal to 0, flatter curve, greater than 1, steeper curve, less than 1, and the middle finger is equal to 1. So this is for demand, this is for supply. Supply curve is upward sloping, demand curve is downward sloping. So this 5 plus this 5, thus ka dam, horizontal, vertical, flatter, steeper, equal to 1. चलो बच्चा लोग, are we clear? Yes, everybody. Priya, Ferdul, Abu, Vasant, Preeti, Kavya. Now there are methods in estimating national income. So what are the methods in estimation of national income? The first is ratio method, same formula, no change. We use this method when the change is small. Then we have arc method. Arc method is between two goods, between 2 points. So this should be between 2 points, and we consider average. So your formula is Q1 minus Q2 upon Q1 plus Q2 multiplied by P1 plus P2 upon P1 minus P2. Shukriya Vasant. So you will have to remember the formula. When the change is large or substantial, use arc method. When the change in price and quantity demanded is less, use ratio method. All right, everybody. Next one is by the name of geometric or point method, and the formula is E is equal to L upon U, that is lower segment of the demand curve upon the upper segment of the demand curve. Formula is ELU. E is equal to L upon U. L for lower segment of the demand curve, U for upper segment of the demand curve. We will use this method when the change is negligible. For example, a car which is priced in lakhs and the price changes by rupees 100. Oh my god. In a car which is worth lakhs, 100 rupees is a very small amount. We generally use this with the help of a graph. So at the midpoint, can I say I have drawn a demand curve such that it touches both the axes. Now when this demand curve touches both the axes, we have named the points as A and B. Let us assume the length of the segment is 4 centimeter and we have distance of 1 centimeter each between point A to P, P to Q, Q to R and R to B. So if you calculate at the midpoint, we get the answer as 1. Above the midpoint at point Q, we will get answer as greater than 1. Then below the midpoint, we will get the answer as less than 1. At point R, on the y-axis, E is equal to infinite and on the x-axis, E is equal to 0. So it's basic simple calculation, L upon U, lower segment upon the upper segment. At point Q, the lower segment is QB upon QA, 2 upon 2, answer is 1. Or at point P, the lower segment is PB upon PA, which is 3 upon 1. At point R, the lower segment is RB upon RA, which is less than 1. At point A, we have the lower segment, but we don't have the upper segment, so infinite. And at point B, we have the upper segment, but not the lower segment, so 0 upon 4 is 0. Point method is to be used when the change is negligible. Now, dear students, the next part of this chapter, that is total outlay method, is very important because total outlay method can be understood from consumer as well as producer point of view. So this is one of those methods that gives you both the point of views, not only the consumer's point of view, but also the producer's point of view. Now, total outlay method. Outlay means expenditure. One man's expenditure is another man's income. I repeat, outlay means expenditure. One man's expenditure is another man's income. Income means revenue. So if you observe, outlay or expenditure is from the point of view of consumer. Income and revenue is from the point of view of producer. Yes or no? Are we understanding? Yes, CA aspirant. Now, in this method, we have absolutely no formula. And if there is no formula, we will call it as an observation method. Because we will get the answer by observing the relationship. Relationship between whom and whom? Between price and total outlay. So till this point of time, we had a habit of comparing price with quantity demanded. But in this method, we will compare price with total outlay, not with quantity demanded. Yes or no? Now, there are three possibilities. There is no formula. So, what is the case number 1? That price may rise or fall, but total outlay remains constant. Then we call it as a base case, and base case is always equal to 1. Base is equal to 1. So in total outlay method, first of all, we need to understand that outlay means expenditure. Expenditure means revenue. Revenue means income. Because one man's expenditure is another man's income. Whenever you talk about total outlay or expenditure, it is from the point of view of consumer. Whereas whenever you talk from the point of view of income or revenue, then it is called as producer's point of view. In this, we are going to have a formula. There is no formula. So how do we get the answer? By comparing the relationship between price and total outlay, not the relationship between price and quantity demanded. We have a habit of comparing price with total outlay, but please remember that we will not. We will compare price with total outlay. If total outlay remains constant, E is equal to 1. Now what can happen? There can be direct relationship as well. If price rises, and imagine if your expenditure still rises. Ayo, if price rises, generally the expenditure falls. But you have increased your expenditure, which means this commodity is important for you. Which means either you are habituated, or it is a necessity, or it is a commodity which you favor, which your taste preferences are in favor. That means that the demand for the commodity is inelastic. So whenever you get a direct relationship between price and total outlay, whenever you get a relationship between price and total outlay, which is direct, it means that irrespective that the price has risen, your expenditure is rising. You tell me, if the price of rice in Chennai goes up, will you still purchase rice? Yes, that means your expenditure will go up. Yes, which means that rice has inelastic demand for you. But the same commodity might have elastic demand for me, because I might not purchase. So when the price of rice goes up for me, then the expenditure can go down for me. So commodity is the same, but for you and me, the demand is different. Yes, Priya. So if, for example, you are habituated to drinking kapi, if you are habituated to drinking kapi and the price of kapi goes up, will you still drink kapi? Yes, sir. That means your expenditure will go up. Yes, sir. And if expenditure goes up, relationship is direct, then the demand is said to have inelastic demand. Am I clear, Miss Priya? But I don't like kapi. I like tea. So if the price of coffee goes up, I will substitute coffee with tea. That means my expenditure on coffee will fall. So relationship is inverse. The commodity is the same, but the relationship differs. That means, are you supposed to focus on the commodity or on the relationship? Focus on the relationship, not on the commodity. If the relationship between price and total outlay is direct, that means the commodity has inelastic demand. If the relationship between price and total outlay is inverse, then the demand is elastic. Yes, Priya, are we clear? Do you want me to give you another example? So Priya, for you, let's change the example. Tea. So if the price of tea goes up, will your expenditure on tea go up? Earlier tea was available, for example, 10 rupees a cup. Now the tea is for 15 rupees a cup. So your expenditure will rise 5 rupees per cup. चाय मेरे लिए सब कुछ है. क्या बात है वसंत, आप हिंदी में बात कर रहे हो, मैं इंग्लिश में बात या तमिल में बात कर रहा हूं. ये वक्त बदल गया, हालात बदल गए, जज्बात बदल गए. So Priya, this method is based on taste and preferences of a consumer. If you favor a particular commodity, Kavya, your expenditure on that commodity will fall ke rise. You love that commodity. For example, pani puri. I love pani puri. So if the price of pani puri goes up, my expenditure on pani puri will also go up. Yes or no, Kavya? So for me, pani puri's price matters or matters less. If it matters less, inelastic. Yes, Miss Kavya S. Vasant, Priya, CA aspirant, Amu, Abu. Are we all clear? Okay, Kavya. So basically, as I told you, Kavya, this method is dependent on the taste and preferences of a consumer. If a consumer prefers a commodity, then the demand is inelastic. And if the consumer does not prefer a commodity, then the demand is elastic. But for that, you will have to observe the relationship. All right, then. Now, what are the determinants of elasticity of demand? This I believe everybody understands. Beta, elastic means there will be more change in quantity demanded. Inelastic means less change in quantity demanded. So, if it is a necessity, the demand is inelastic. If it is a comfort or a luxury, then the demand is elastic. Whatever may be the price of a necessity, we will purchase. So, demand is inelastic. So I want you all to go through these points and let me know if you have a doubt in any of the points. If not, then we will go to the next part, that is supply. The first point is already done. Do you want me to explain any of the points? Durability, availability of substitute, habitual goods, complementary goods, number of uses, income earned, income spent. All right. Let me know in the chat box if you have any questions or queries. If a good is durable, then price matters. If the good is perishable, the price does not matter. If there is no substitute, सर आप पहले ही समझा देते हैं कि हमारे लिए सब कुछ काफी है. शुक्रिया वसंत. आप इतनी हिंदी कहाँ से बोल रहे हैं? आपका नाम वसंत राज है. So I am sure you are a Tamilian. This is actually, I have covered majority of the points. So honestly speaking, if you know the concept of elasticity of demand, you should be able to answer them all. All right, then I think we are done with this concept. Last 2 minutes. Please go through this concept and let me know. Yes, dear students, I hope you all have understood what is demand, what is elasticity of demand. Hannah, you need to download the HiQ Professional Academy's app. I think that is the place where you will get all the notes. So be rest assured that the notes will be shared with you all. You need to apply, or you need to rather download the app, register yourself, and the notes will be shared with you all. Yes, Kavya, Priya, Abu, Yamuna, Vasant, Henna, Preeti, Priya. Shall I go ahead? Now, there is a concept called as supply, which I believe is a simpler concept. Now, whenever we talk about supply, first we need to talk about production. Production is defined as creation of utility. So, Faridul had a doubt. Faridul, time period. Suppose if you are in urgency, you have very limited time available. You want to go to a party and you don't have party wear clothes. So where will you purchase your clothes from? Even if they are expensive, will you purchase or not? So when we have limited time available or short run, when there is urgency, then the demand is inelastic. We do not look at the price. Whatever is the price, we pay that price. Yes or no? Suppose if you have enough time available with you, thank you so much, Hannah. All right. So, Faridul, in the short run, the demand is inelastic. In the long run, the demand is elastic. Because in the long run, you have abundance of time available. So you can choose your price and what price do you want to purchase at, because there is no urgency as such. So Faridul, moving to the next part, that is production. Production is defined as creation of utility such as place utility, form utility, time utility. What is utility? Utility is the want satisfying power of a commodity. I am sure you are aware about that. So whenever we talk about production, it is a process of converting input into output or raw materials to finished goods. So whenever there is production, from production we get output. Output is whatever you have produced in the current year. From output we get stock. Stock is your ability to supply. From stock we get supply. Supply is your willingness to sell, not sold. What are you offering for sale? So it is called as willingness to sell or offer for sale. From supply you will get sales. Sales is what you have actually sold. From sales, we will have revenue, which will be given to the factors of production in the form of rent, wages, interest, and profits, which are called as factor payments. So, beta, from production we get output, from output we get stock, from stock we get supply, from supply we get sales. Sales, we will have to make factor payments in the form of rent, wages, interest, and profit. Supply is also a relative term related to price as well as time. Higher the price, higher the supply, lower the price, lower the supply. So the relationship is direct. The very first determinant is price of a particular good. Direct relationship. With cost of production, we have inverse relationship since capital is limited. So when cost rises, your supply falls. Why? Because we have limited amount of capital. And if the capital is limited, that means supply will decrease. So I've given an example. If my capital is rupees 1 lakh, cost is rupees 1, I can produce 1 lakh units. If the cost rises to 2, can I produce 1 lakh units? Because I have only 1 lakh rupee capital. So I will be able to produce only 50,000 units. So when cost rises, your supply falls. Yes or no? The third part is technology. If the technology is latest, then the supply will increase. If the technology is outdated, then the supply will decrease. Future expectation is inverse relationship in supply because this is producer's future expectation. If a producer expects the price to rise in the future, then his present supply will decrease. Similarly, government policy can be either favorable or unfavorable. Favorable when the indirect taxes are less and subsidies are more. Indirect tax is paid by us to the government, whereas subsidies are received from government to the producer. Yes or no? So either the government policies are favorable or the government policies are unfavorable. If the policies are favorable, supply will be more. Unfavorable, then the supply will be less. Then comes climatic conditions, favorable and unfavorable. It is specifically for agricultural goods because agricultural goods supply will get affected by climate. So if the climatic condition is favorable, then the supply will be more. There will be increase in supply. If the climatic condition is unfavorable, then the supply will be less. There will be a decrease in supply. Then price of substitute good. If you are a farmer, if you are getting more price for wheat, you will manufacture more wheat. Therefore, you will supply more wheat, which means the supply of rice will fall down. Suppose if the price of cabbage offered in the market is more, then will you produce and manufacture more cabbage? Obviously, more production would lead to more supply of cabbage and result into a lesser supply for cauliflower. Yes or no? Understanding or not understanding? So, in demand, substitute goods have direct relationship, but in supply, substitute goods have inverse. In demand, future expectation price was direct. In supply, it is inverse. So, basically, exactly opposite of demand is the chapter of supply. Number of sellers, more the supply. Single seller, less supply. Then supply also gets affected due to two factors. One is price, one is other factors. Whenever it gets affected due to price, we will call it as variation in quantity supplied or change in quantity supplied. This change in quantity supplied is further divided into two parts, expansion and contraction. But in demand, this was contraction. In supply, this is expansion. Higher the price, higher the supply, expansion. Lower the price, lower the supply, contraction. Same price, more is supplied, increase in supply. Same price, less is supplied, decrease in supply. So, in demand, inverse relationship. In supply, we have direct relationship. Yes, Kavya? Are we clear? So if you get movement along the curve, it is expansion and contraction. If you get shift of the demand curve, we call it as increase and decrease. When you study expansion and contraction, the price will vary and other factors will remain constant. Then elasticity of supply is same as elasticity of demand. Formula is percentage change in quantity supplied upon percentage change in price. Then we had 5 curves: horizontal, infinite, vertical, 0, flatter, greater than 1, steeper, less than 1, middle finger is equal to 1. Arc elasticity method, ratio method. And then we have what is surplus, scarcity. So if I ask you a question, if demand is greater than supply, what will you call it as? Demand is greater than supply. We call it as excess supply, or we can call it as surplus. Whenever there is surplus, the price will fall. Yes, dear students, are you all there? Do you agree with me? No, beta, whenever there is surplus, the price falls. The commodity is available in abundance. So I have the commodity. I am willing to sell, but nobody is coming to purchase. And if nobody is willing to purchase, what will happen? I will have to reduce my price. No, Priya? Okay, Priya, shall I go ahead? Do you agree with me? You have to think from producer's point of view. That supply is more. No, he has more available goods. Then next can be demand is equal to supply. If demand is equal to supply, we call it as equilibrium. And under equilibrium, price remains constant. We do not want to shift from this point. And there is another possibility that demand is greater than supply. We call this point as excess demand, or we call it as scarcity. Now people are demanding, but I don't have the goods. Correct, Vasant. So if demand is high and I don't have the supply, then the prices will rise. So we need to understand three concepts: surplus, equilibrium, and scarcity. The most desired one is equilibrium. Surplus and scarcity are not desirable from the point of view of economy. No problem, Priya. I hope now you have understood. Yes, Priya. So, beta, when demand is greater than supply. Oh, 1 second. I actually did not write it correctly. My mistake, Priya. Demand is less than supply. Then you can say that there is excess supply. So I think it was my mistake that I did not write the sign properly, and maybe that's why you got confused. Sorry, Priya. Now I hope I am clear. Everybody, Vasant, Priya, Amu, everybody is clear. Excess supply means surplus. Excess demand means scarcity. And we have drawn the diagram of equilibrium. Demand curve is a downward sloping curve. Supply curve is an upward sloping curve. And where demand and supply meet each other, we call it as equilibrium price and quantity. Above the equilibrium, we get surplus. Below the equilibrium, we get scarcity. All right. Then moving to the next concept of utility. Beta, utility is the want satisfying power of the commodity or the capacity of the commodity to satisfy a human want. I hope everybody knows that there are concepts like total utility and marginal utility. Total means aggregate, sum or whole, whereas marginal means last, extra or additional. Total utility increases but at a diminishing rate, whereas marginal utility falls. It can be positive, then zero and negative. But this you have studied in your +2 levels, in your 12th standard. So I don't think there is a need for me to explain the law of diminishing marginal utility. What are the things that you need to remember? That marginal utility can be positive, zero or negative. Marginal utility has an impact on total utility. When marginal utility is positive, total utility increases at a diminishing rate. When marginal utility is zero, total utility is maximum. When marginal utility is negative, total utility falls. So this is the relationship between marginal and total utility and the diagram. Then there is a concept called as consumer surplus. Yes or no? Consumer surplus in simple language is price willing to pay minus the price actually paid. Price that you are willing to pay minus the price that you have actually paid. So can I say the price that you are willing to pay? First of all, consumer surplus is also called as extra utility. The price that you are willing to pay is the maximum price. And the price that you have actually paid is the market price. So for example, I love Shah Rukh Khan movies. I am willing to pay 500 rupees for his movie. But when I went to the theater, I got the tickets only at rupees 300. So how much was my willingness to pay? 500. How much did I actually pay? 300. So how much is the extra utility? 200. But a maximum price, because this is the amount of satisfaction that I am going to receive. Whereas minimum price or the market price is the sacrifice. In economics, we call it as mu of x minus price of x. This is consumer surplus, this is also consumer surplus, this is also consumer surplus. So consumer surplus is what? It is the extra utility. Extra utility is the price that you are willing to pay minus the price that you have actually paid. It is the maximum price minus the market price, or the satisfaction minus the sacrifice. Or in economics, satisfaction is denoted by mu, marginal utility. Sacrifice is denoted by price. Yes or no? Yes, Yamuna, Priya, absolutely correct. Now, we are studying this under perfect competition. And beta, under perfect competition, prices they remain constant. So if I have to draw a curve This is my price P of X. This is my marginal utility curve mu of X denoted by M. This is the origin. This is the point at which both are at equilibrium. And this is the number of units. So at point E, mu of X is equal to price of X. We call this point as consumer equilibrium. So when mu of X is equal to price of X, we call it as consumer's equilibrium. So in the diagram, can you people tell me how much am I willing to pay? Am I willing to pay till point P or am I willing to pay till point M? At point P, I will stop my consumption. So my next question is, how much am I willing to pay? I am willing to pay an amount of OMEQ. Sir, why OMEQ? Because M is the point of marginal utility and I am willing to pay that much. That is the maximum that I am willing. Yes or no? So I am willing to pay OMEQ. But how much have I actually paid? Have I paid till point M? How much is my actually paid? I have paid only till point P. So minus OPEQ. So what is the balance? This area is called as consumer surplus, where my mu of X is greater than price of X. And the area of PME is my consumer surplus. Yes, dear students, are you all there? Have you all understood? Are we very, very, very clear? Can I have a reply in the chat box? रोम्बा नल्ला. Thank you so much, Vasant. आप भी कमाल कर रहे हैं. Thank you for being in the class consistently over the last 2 hours. It really means a lot. We will give our best and we will clear our exams. Let that be our motto. So the last part of this chapter is by the name of utilities ordinal measurement. So beta, when we study utility, there is one measurement cardinal, the other is called as ordinal. Cardinal measurement was given by Alfred Marshall, ordinal was given by Allen and Hicks. Cardinal measurement, we measure in numbers, that is an assumption. We measure in utils. Cardinal measurement is basically marginal utility analysis. Whereas ordinal measurement is indifference curve analysis. In ordinal measurement, we have ranks and preferences. So the first concept is scale of preference. See beta, larger the combination of goods, larger is the level of satisfaction. Smaller the combination of goods, smaller is the level of satisfaction. That is a human nature. So beta, if you are a consumer, we will talk about two commodities. What do you want? A smaller combination of goods or a larger combination of goods? A consumer always prefers a larger combination of goods. So larger the combination of goods, larger is the level of satisfaction. Smaller the combination of goods, smaller is the level of satisfaction. Direct relationship tells us what is the level of satisfaction. More the combination of goods, more satisfied you will be. Lesser the combination of goods, the lesser you will be satisfied. So under indifference curve, you give me any combination, I will receive the same level of satisfaction. Indifference curve is applicable to imperfect substitute goods, wherein if one commodity's consumption increases, another commodity's consumption decreases in such a manner that all the combinations give me the same level of satisfaction. So what is the concept of indifference curve? All the points on one indifference curve give you the same level of satisfaction, in which you get an inverse relationship. So if you increase the consumption of one commodity, you will reduce the consumption of another commodity. Here I generally use a famous dialogue from Shah Rukh Khan movie. कुछ पाने के लिए कुछ खोना पड़ता है सेनोरिटा. So if you lose Y commodity, if you reduce the consumption of Y, your level of satisfaction will fall. So what will you do? You will increase the consumption of X commodity in such a manner that your level of satisfaction remains the same. So all the points on one indifference curve give you the same level of satisfaction. Yes or no? Understanding or not? So here you can find your marginal rate of substitution. You substituted 4 units of Y for 1 unit of X. So your MRS is 4. आप नहीं Hank. Beta Priya, I didn't understand. Very good, Ferudul. I am glad that you are understanding. Now, how many units did I use from B to C? I lost 3. I gained 1. So my marginal rate of substitution is 3. And so on, my MRS is diminishing. So beta, if there is inverse relationship, we will get downward sloping curve. And if the MRS diminishes, then the curve is convex to the origin. It is a bowed in curve. Now, what are the properties of indifference curve? Indifference curves are downward. Why are they downward? Because there is inverse relationship between X and Y. Indifference curves are convex to the origin. Why are they convex to the origin? Because MRS diminishes. How do we calculate MRS? Delta Y upon delta X. Higher the indifference curve, higher is the level of satisfaction. So beta, all the black color points will give me same level of satisfaction. Yes or no? All the points on one indifference curve give the same level of satisfaction. All the red color points will also give me same level of satisfaction. But it will give me a higher satisfaction than IC1, because indifference curve is to the right. Higher the indifference curve, higher is the level of satisfaction. Yes or no? And if I go on IC3, jingle bell, jingle all the way. Hey, have I made a Santa Claus or a lighting? No, no. These colors represent that all the points on one indifference curve. Black color, same satisfaction. Red color, same satisfaction. Green color, same satisfaction. But green is greater than red is greater than black. Yes or no? That is the reason why I have written that IC3 is greater than IC2 is greater than IC1. When you draw multiple indifference curve, it is called as an indifference map. So all black color, same satisfaction. All red color, same, but greater than black. All green color, same, but greater than black and red. So IC3 is greater than IC2 is greater than IC1. Indifference curve cannot intersect and cannot touch the axis. I hope I am clear with that. Do you want me to explain? Can two indifference curve intersect each other? Because if they intersect each other, example of what, Yamuna Devi? What example do you want me to give? So the curve on the right represents larger combination of goods, and larger the combination, larger is the level of satisfaction. So if the indifference curve is drawn to the right, it means, ayo, indifference curve, beta Pepsi and Coke, Lays and Balaji, imperfect substitutes. So if you reduce the consumption of one, you will increase the consumption of another. So any two commodities which are imperfect substitutes to each other, this concept is applicable, Yamuna. Surf Excel and Nirma, washing powder Nirma, Nirma. Okay, Yamuna. Okay. So can indifference curve touch the axis? No, they cannot touch the axis. Can they intersect each other? Cannot intersect each other. So total there are how many properties of indifference curves? 5. Indifference curves are downward sloping. Indifference curves are convex to the origin. Higher the indifference curve, higher is the level of satisfaction. Lower the indifference curve, lower is the level of satisfaction. Two indifference curves cannot intersect each other because it would mean that IC1 and IC2 give the same satisfaction. But we know that IC2 gives greater satisfaction than IC1. Hence, two indifference curves cannot intersect each other. And they can neither touch the axis, because if it touches the x-axis, y coordinate is 0. If it touches the y-axis, then x coordinate is 0. We need two units, two commodities. So it cannot touch the axis. Then we need to talk about the budget line. Can we purchase as many goods as we want? Because all consumers have to face the problem of budget and price. So suppose if my budget is rupees 50, the price is rupees 5 and 10 respectively of X and Y commodity. So what will be the formula for budget? Budget is represented by B or M. It is P of X into Q of X plus P of Y into Q of Y. Now, suppose if I spend entire money on Y. So how much is one Y worth? 10. So 5 into 10 is 50. So I cannot purchase any units of X. So 0 units of X, 5 units of Y. Suppose if I reduce consumption of Y, I will increase the consumption of X such that I am spending my entire budget. 1 unit of Y is 10, 4 units of Y will be 40. So 2 units of X, 1 is for 5, 2 into 5 is 10. So here you will spend 10, here you will spend 40, your total is 50. Here you will spend 20, 30, your total is 50. 30, 40, 50. So this will be 20, 10 and 0 rupees. A yes or no? So all the points A, B, C, D, E, F. I am purchasing that combination and in such a manner that my entire budget is spent. So points A to F are on the budget line, utilizing my entire budget. My A point is 0, 5 units, B point is 2, 4, C point is 4, 3, D point is 6, 2, E point is 8, 1 and F point is 10, 0. Now Yamuna, can I purchase a Z combination which is 5, 4? 5 units of X will cost me 25. 4 units of Y will cost me 40. Do I have a budget of 65? I have a budget of 50. So point Z is outside my budget line. ऑक्स के बाहर जाने का नहीं, औकात के बाहर जाने का नहीं. You should not go outside your budget line. Should I purchase a combination 2, 3 which underutilizes my budget? So I can't go outside the budget. I should not remain within the budget. Then where should I be? I should always be on the budget line. So consumer should always be on the budget line. Yes, dear students, are you all there? Are you all understanding? Are we clear? Chalo, everybody, are there any questions? Are there any doubts? Yes, Hannah. ரொம்ப நல்ல. Any questions, any queries till now? If not, then we go to the last part of today's class and then I will solve a few MCQs, maybe 10 to 15. All right. So, beta, if you have understood everything, then you will answer my next question. In this diagram, where is a consumer at equilibrium? You have to answer this. In the diagram, the consumer is at equilibrium at point P, Q, R, S, T. All 5 points, any 2 points, any 4 points, or 1 point. Rombanalla Purinjitu, sir. Now I don't understand the meaning of the word Purinjitu. I have heard the word Rombanalla Irku. Purinjitu means completely. Completely Rombanalla. Very good, Henna. Absolutely correct. Rombanalla Irka. Yes, Vasant. 1 point. Which point? So consumer is at equilibrium at point R, which is on IC3, where budget line is a tangent to the indifference curves. That's wonderful, Priya. Then there are certain exceptions to the indifference curve. Curve can be a linear curve or an L-shaped curve. Linear is for perfect substitutes and L-shaped curve is for perfect complementary goods. So you just need to remember two things. Perfect substitute, the curve is a linear downward sloping curve. Perfect complementary goods, it is an L-shaped curve. So dear students, can we go to the MCQs part? Will you all answer a few MCQs? There is another concept in this chapter by the name of demand forecasting. Forecasting means estimating the demand of the future. There are two techniques, statistical and non-statistical, quantitative and qualitative. Quantitative are more accurate, qualitative are less accurate. When you forecast the demand, this demand forecasting is generally done by the producer to estimate the demand in the future. So I don't think so anybody should have a query. Shall we go ahead? So tell me what is your answer for question number 1. Tamil Selvam illa. Tamil illa. You military ni inaya ing. Shall I go? Because I have not understood anything except you and military. Do I look like a military guy? No, no, Anna, I am a teacher. Chalo, everybody give me the answer for question number 1. Here we go. Contraction is due to other factors or due to price? Price of other good ke good concerned. The answer is the B. Increase in price of good concerned, same commodity. Question number 4. I will discuss 10 to 12 MCQs from demand, supply, elasticity of demand. Yes, dear students, what is the answer for question number 4? If you expect the future price of rice, future expectation about price of rice to rise, then the demand will increase. Therefore, your answer is A. Question number 5. Chicken and fish are substitute. Substitute goods have direct relationship. So if the price of chicken increases, the demand for fish will also increase. So increase and the demand curve will shift to the right. So your answer is B, Miss Yamuna. Are we clear? Absolutely correct, Yamuna. Next, with an increase in price of diamond. So when the price of diamond rises, the demand for diamond is a social status commodity. Demand for diamond will also rise. Therefore, there is direct relationship. We call this good as a conspicuous good. The answer is C. Priya, diamond is a conspicuous good. Shall I go ahead? Shall I go ahead, Priya? So in tomorrow's class, we are going to discuss theory of production and cost. Do come well prepared with it. We will be focusing and targeting the important concepts. Do not come unrevised. These lectures will be helpful to you only and only if you are revised and you have come for certain doubt solving. Now let us solve certain questions on elasticity of demand. If the demand for a good is inelastic, price increases. Demand is inelastic means there will be less change in quantity demanded. So total outlay will increase. The relationship is direct when the demand is inelastic. So example is Pani Puri. If the price of Pani Puri rises, Vasant, I have already discussed demand forecasting. If you have any specific doubts, you can ask. Demand forecasting is the forecasting of the future done by the producer to predict the demand of the future. It has two methods, quantitative, qualitative. Quantitative are more accurate, qualitative are less accurate. So nothing very important, Vasant. You just need to read that once. If you have any doubts, you can ask me in tomorrow's class. But demand forecasting is not a very important part of your syllabus. Something which can be done as self-study. Next, if a good is a luxury goods means percentage change in demand will be greater than percentage change in income, which means demand is elastic. Elastic means greater than 1. So answer will be positive and greater than plus 1. Answer will be C. Question number 6. As income increases, demand for superior goods increases. But that is not the case in case of inferior goods. If income increases, demand decreases, then we call them as inferior goods. The relationship is inverse, means negative income elasticity of demand for inferior goods. Your answer will be B. And then we can solve a sum. Price P1 which is 6 and 4. Quantity Q and Q1 which is 10 and 15. Now if you observe these numbers, they are pretty small. So we can use a ratio method. Delta P is equal to 4 minus 6. Therefore, delta P is minus 2. Delta Q is equal to 15 minus 10. So, delta Q is equal to 5. Now, use the formula delta Q upon Q into P upon delta P. Delta Q is 5, original quantity is 10, price is 6, change in price is minus 2, which is equal to 30 upon minus 20, which is equal to minus 1.5. But we ignore the negative sign. Therefore, your answer is A. 1.5 is the final answer. Yes, dear students, are we clear? Next is from supply. So what is supply? The supply of good refers to what? Is it actual production? Nah, nah. Is it stock? Nah, nah. Stock available for sale? No, no. It is the offer for sale at a particular price and time. So answer is D. There is some error, Vasant Raj. Next one. A increase in supply of good. Increase in supply is due to other factors. So latest technology, supply curve will shift to the right, increase. Fall in price of other good, it will increase, it will go to the right. Fall in price of factors of production means cost of production will fall, supply will increase. Again, this will go to the right. Therefore, your answer is D. Now, in the book market, the supply of book will decrease except. So you need to find one factor because of which the supply of books will not decrease. I repeat, find one factor because of which supply of books will not decrease. So this is decrease in supply. Number of sellers less, supply will also be less. But B option, decrease in price, will lead to contraction in quantity supplied. When price falls, supply contracts. So your answer is B. They have asked you to find one factor because of which the supply of book will not decrease. So supply of book can contract. Contraction is due to price. Future expectation about price, again it will result into decrease in supply. Cost of production increases, supply will decrease. So three factors will result into decrease. Only one factor will result into contraction. Therefore, your answer for fourth MCQ is B. Chalo, let's solve question number 1. I hope everybody is clear. Keep replying in the chat box. There are 30 students in the classroom. I request everybody to please like, share, subscribe, comment, and hit the bell icon. Yeah, if you have enjoyed today's lecture, definitely give me a thumbs up. Would love to see your comments in the chat box. I hope you all have understood the lecture till now. So after the lecture gets over, do comment in the section. Chalo, total utility is maximum when marginal utility is 0. The answer is A. Third question. The consumer is at equilibrium at the point where budget line is a tangent to the indifference curve. So your answer is C. What do you mean by consumer surplus? It is the maximum amount that you are willing to pay minus the market price. So your answer is C. And with that, we are done with the revision of unit number, rather chapter number 2. If you have any other doubts, any other queries, you can post in the chat box. That's it from me today. Thank you so much. Any questions, any queries, post it in the chat box and I'm here to solve your doubts. Are we done then? Can I have a reply in the chat box? Yes, Fairidul. I hope to see you all in tomorrow's class. Requesting everybody to definitely like the video. If possible, do drop in a comment. I would love to read your comments today. So after the lecture gets over, I might check and see what are the comments that you all have given me in the chat box and the comment section. Notes will be shared with you in the Thankyou app. Bye, Yamuna Devi. Good night. Vasant, expansion and contraction is due to price, and increase and decrease is due to other factors than price. Expansion and contraction are on the same demand curve or supply curve, whereas increase and decrease there will be shift of the demand curve. If you can be more specific about your doubt, I can help you. Thank you, Vanaja. Thank you, Priya. Bye bye. Yes, Vasant Raj. So, if price rises, quantity demanded falls. This is called as contraction. If price falls, quantity demanded rises, it is called as expansion. If price is constant, demand increases, then it is due to other factors. If price is constant, demand decreases, then it is due to other factors. So basically there are two factors. Upward movement price, contraction, downward movement in price, expansion. Same price, more is demanded, increase, same price, less is demanded, decrease. Price of particular, so price of X, demand of X. Alright, Vasant. Are you sure? Are we clear? Done, 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 done. So that's it from me today. Thank you so much, everybody. I'll see you all in the next class.